Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. Okay, what we're looking at today are the U.S. market peripheral notes for Thursday, April 16th, 2026.
This video presents a direct informational narration of the source document.
So here's our roadmap. First, we'll tackle the big picture macro story. Then we'll drill down into market performance and the technicals. After that, we're going to talk about the shifting logic in the AI industry, analyze who's actually funding this rally, and look at some key sector rotations and individual stock moves. And finally, we'll wrap it all up with a summary and outlook. All right, let's jump right in with our first section, the macro narrative. What's happening is a really fundamental shift. The market is moving on from what you could call risk premium repair, just reacting to geopolitical tensions, and it's starting to focus on certainty premium pricing. In other words, solid fundamentals are beginning to matter again. So what's driving this? A lot of it has to do with the US-Iran negotiations. The talks have really leveled up. It's not about if they can get a deal anymore, it's about how to implement it. We're hearing about a preliminary consensus on huge issues like the Strait of Hormuz and uranium enrichment. And with political pressure building, plus a substantive signal from former President Trump about wanting a deal by the end of April, a sense of real urgency is set in. But this leads to a pretty significant risk. See, the market seems to have collectively decided that April 21st is the deadline for this consensus. And whenever everybody expects the same thing to happen, well, that's when you have to be careful. We could be looking at a classic sell the fact situation where the good news is already priced in and the actual announcement triggers a pullback. Okay, so with that macro context, how's the market actually behaving? That brings us to section 2. We're seeing some hesitation, for sure, but the underlying trend is still incredibly strong and key support levels are holding. Just think about this number for a second, 12. The Nasdaq has put together 12 straight days of gains. That's the longest winning streak we've seen since 2019. And this isn't just a few stocks carrying the load. This shows real market breadth and a total capitulation from anyone who is betting against this market. Now, on the charts, we did see what's called a doji pattern. It basically signals a pause, a moment of indecision. But here's the thing. When you look at history, this kind of hesitation after a massive run-up is usually just that, a pause. It looks a lot more like simple profit-taking on a high plateau than the beginning of a real reversal. The market's just catching its breath. And this speaks to a core rule that experienced traders live by. You just don't short a vertical bull market. It's about survival. The rational move isn't to bet on a crash, it's to maybe reduce your position size, take a little off the table. You absolutely have to respect this kind of momentum. Now, speaking of momentum, so much of it has been driven by the AI story. But as we move into section 3, we're seeing that story change. The narrative is evolving. It's no longer enough to just announce massive spending on AI infrastructure. Now, the market is starting to demand answers about the return on that investment. And the spending, it's just off the charts. We're talking about a projected $150 billion in capital expenditure from cloud hyperscalers. That's a 92% increase year over year. It's a completely unprecedented infrastructure build-out. But here's the tension in the story. While CapEx is exploding higher, free cash flow is actually trending down. All that spending is putting immense pressure on margins, even at giants like Microsoft and Meta. And that sets up a huge test on April 29th with Microsoft's earnings. The market is going to be watching very closely to see if they can turn all that investment into actual revenue. This all leads to a critical line in the sand, the 7,000 level on the S&P 500. You could say the rally to 7,000 was powered by valuation logic, the promise of what AI could do. But to stay above 7,000, earnings logic has to kick in. The tech titans have to prove that AI is actually making them money. If they can't, holding that level is going to be tough. So who's doing all the buying that got us here? Let's get into the funding structure. And here's the thing. This isn't about retail investors piling in with FOMO. This is an institutional pain trade. It's the big money managers who are probably underweight being forced to buy just to avoid falling behind. Look no further than Goldman Sachs for a perfect example of this. You might even call it an institutional embarrassment. When the index was at 6,782, they were calling for 7,000 to be a major top. Then the market blew right past it, and suddenly they're raising their target all the way to 7,200 or 7,300. It's a textbook case of capitulation. They got it wrong, and now they're forced to chase. And what happens when all that institutional money gets forced to buy in at these higher prices? Well, their perception of the market's floor completely shifts. The new last line of defense, the key level that must hold to keep this trend alive, is now seen as 6,840. Let's dig a bit deeper now into where the money's actually moving. We're in Section 5, and we're seeing some healthy rotation, which is good, but we're also seeing some pretty abnormal volatility pop up in certain places. And that's leading to some really wild individual stock stories. You've got Oracle with a clean technical breakout. Then there's Avis Budget, which went on an epic short squeeze, tripling in just 2 weeks on massive short interest. On the other hand, you have a name like Nike, where even the executives buying stock couldn't convince the market. Then we have ARX, a new IPO, surging nearly 40% thanks to the SpaceX halo effect. And Albemarle jumped 16% on news of a refinery fire, a perfect example of a short-term narrative just steamrolling the facts. When you put it all together, especially how stocks are reacting after they report earnings, one thing becomes crystal clear. The bar is so much higher now. Up here at the 7,000 level, good enough is no longer good enough. The market has shifted entirely from rewarding sentiment to demanding hard evidence of earnings. Any little imperfection is enough to cause a rapid withdrawal of liquidity. Okay, so let's tie this all together. What's the outlook from here? This brings us to our final section. And honestly, the next couple of weeks feel absolutely decisive for the market's direction this year. And that boils down to one central question. Is this rush into earnings season going to be new fuel for the rally, or is it the end point? The market is now at a place where it doesn't just want good results, it seems to be demanding perfection. And if you need a warning sign, just look at Netflix. Their results were strong, they beat expectations, but the stock dropped hard. Why? Because their guidance for the future was a little weak. It's a flashing red light that at these elevated valuations, the market's tolerance for any error is approaching zero. So, what's the bottom line? While we're on this high valuation plateau, the trend is still bullish as long as that key 6,840 support level holds. But this is a time for caution, for being on high alert for good news exhaustion. The really smart approach right now might be to be more selective, to focus on the specific technology leaders that can prove they can absorb all the spending pressure and turn it into profit. That's where the greater certainty lies.